My dear students, welcome back to our channel. In this video, I will be explaining the MBA second semester subject Financial Management as prescribed by Osmania University, Palamuru University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Unit 3 first important short question is the financing decision. The financing decision means deciding how a company will raise money to run and grow its business. A business needs funds for buying machinery, paying salaries, building infrastructure, etc. This money can come from equity, shares, debt, loans, or retained earnings, past profits. There are two main types of financing. 1. Equity financing, money raised by selling shares. Owners don't have to repay it, but they share profits. 2. Debt financing, money borrowed from banks or lenders. It has to be repaid with interest. Key point: the company should choose a financing method that gives the lowest cost and highest benefit. Example: if a company wants 10 lakhs rupees, it can take a loan, debt, or issue shares, equity. Debt has interest, but equity reduces control. So, the company must compare and decide the best option. Easy tip: debt is cheaper but risky. Equity is safer but costly. Good financing is equal to proper balance. Next important long question is 2. Financial instruments. Financial instruments are tools used by companies or individuals to raise or invest money. They are like contracts that show a financial relationship, for example, borrowing, lending, or investing. There are two main types. 1. Debt instruments. These include bonds, debentures, and loans. The borrower promises to repay with interest. Example: a company issues debentures of 1 lakh rupees and agrees to pay 8% interest yearly. 2. Equity instruments. These include shares. Investors become part owners and earn dividends. Example: an investor buys shares of a company and earns 5 rupee dividend per share. Key idea: debt is equal to fixed return, less control. Equity is equal to no fixed return, ownership. Fun tip to remember: debt gives you interest, equity gives you ownership. Companies choose financial instruments based on cost, control, and risk. Using the right mix helps them grow safely and efficiently. Next important short question is 3. EBIT. EBIT, earnings before interest and taxes. EBIT stands for earnings before interest and taxes. It shows how much profit a company makes from its business operations before paying interest and taxes. It is also called operating profit. Formula: EBIT is equal to revenue, operating expenses, excluding interest and tax. It helps us understand how well a company is doing in its core business, like selling products or services, without getting confused by how it is financed. Example: a company earns 10 lakhs rupees from sales. Its operating expenses, like salary, rent, materials, are 6 lakhs rupees. Then, EBIT is equal to 10 lakhs rupees to 6 lakhs rupees is equal to 4 lakhs rupees. So, the company's operating profit is 4 lakhs rupees. Easy tip to remember: EBIT is equal to earnings from business, ignore bank, interest, and tax. It is very useful in comparing the performance of different companies, no matter how they are financed or taxed. Next important short question is 4. EPS analysis. EPS, earnings per share, shows how much profit a company earns for each share held by a shareholder. It helps investors understand how profitable the company is. Formula: EPS is equal to net profit after tax, preference dividend, number of equity shares. Example: a company earns 5 lakhs rupee after tax. It has 1 lakh equity shares. Then, EPS is equal to 5 lakhs rupees, 1 lakh is equal to 5 rupee per share. So, each shareholder earns 5 rupees for every share they own. EPS analysis helps in comparing the performance of companies, taking financing decisions, whether to raise funds via debt or equity, making investment decisions. Higher EPS is equal to more attractive to investors. Easy tip to remember: EPS is equal to easy profit per share. Higher EPS means better returns for shareholders. Companies aim to increase EPS to attract more investors and grow their market value. Next important short question is: 5. Cost of capital. Define significance. Cost of capital is the minimum return a company needs to earn on its investments to keep investors happy. It is like a benchmark. If returns are below this, the project is not worth it. Definition: cost of capital is the cost the company pays to raise funds from different sources like debt, equity, or preference shares. Why is it important? Helps in investment decisions. Example: NPV, IRR. Used to calculate weighted average cost of capital, WACC. Helps in evaluating if a project is profitable or not. Acts as a hurdle rate. If a project returns more than cost of capital, it is accepted. Example: if a company borrows money at 10% interest, then 10% is the cost of capital. If a project earns 15%, it's profitable. If it earns 8%, it's a loss. Tip to remember: cost of capital is equal to cost to keep capital happy. Next important short question is: 6. Average versus marginal cost of capital. Average cost of capital is the overall cost of funds that a company already uses from all sources like debt, equity, etc. It is also called weighted average cost of capital, WACC. Marginal cost of capital is the cost of raising additional, new funds. It reflects the cost of the next rupee the company wants to raise. Example: let's say a company uses equity at 12%, 60%, debt at 8%, 40%. Average cost of capital is equal to 12% times 0.6 plus 8% times 0.4 is equal to 10.4%. Now, if the company wants to raise new funds only through equity at 13%, then marginal cost of capital is equal to 13%. Easy trick to remember: average is equal to total cost of existing capital. Marginal is equal to cost of new capital. Think of average as past and marginal as future. Next unit 3. Long questions. First important long question is: sources of finance. In financial management, sources of finance refer to the different ways a business can raise money to start, run, or expand its operations. These funds can be raised from internal or external sources. 1. Internal sources: money generated within the business. Retained earnings: profits saved by the company instead of giving it to shareholders. Example: Infosys saves part of its profit to invest in R&D. Sale of assets: selling unused land, buildings, or old machinery to raise funds. Example: a factory sells an old truck and uses that money to buy new equipment. 2. External sources: money raised from outside the business. A. Equity financing. Shares: issuing shares to the public. No repayment is needed, but shareholders get part ownership. Example, Reliance raises money by selling shares in the stock market. B. Debt financing. Debentures, long-term loans taken from the public with a fixed interest. Bank loans, borrowing money from banks for short or long terms. Public deposits, money accepted from the public for a fixed period. C. Government grants subsidies. Special funds given by the government to promote industries like farming, startups, or renewable energy. Example, a solar panel startup gets a subsidy from the Indian government. How to choose the right source? A company selects a source based on cost, interest or dividend, time duration, short or long term, risk and control, equity is equal to loss of control, debt is equal to repayment pressure. Easy tip to remember. Internal is equal to inside the company. External is equal to outside the company, equity plus debt plus grants. Conclusion. Choosing the right source of finance is very important. A good financing decision supports business growth, reduces cost, and improves profitability. Next important long question is 2. Capital structure theories. Capital structure means the mix of debt and equity a company uses to finance its operations. For example, a company may use 60% equity and 40% debt. Capital structure theories help us understand how this mix affects a company's value and cost of capital. 1. Net income (NI) approach. More debt is equal to more value. This theory says that using more debt, loan money, reduces overall cost of capital because debt is cheaper than equity. So, increasing debt increases the value of the firm. Example, if Tata Motors uses more debt, its cost of capital decreases and value increases. 2. Net operating income (NOI) approach. Capital structure doesn't matter. This theory says it doesn't matter how much debt or equity a company uses. The value of the company remains the same regardless of capital structure. Example, whether Infosys uses 70% debt or 30%, its total value stays constant. 3. Modigliani and Miller, M.M. Theory under ideal conditions. According to M.M., in a perfect world, no taxes, no bankruptcy, full info, capital structure doesn't affect value. But when taxes are included, debt increases value because interest is tax deductible. Example, a company can save taxes by paying interest on loans, thus increasing its value. 4. Traditional approach, balanced mix is best. This theory says that there is an optimal capital structure, a sweet spot where the cost of capital is lowest and company value is highest. Too much debt increases risk, too little debt misses tax benefits. Example, a firm using 50% debt and 50% equity may have the best balance. Easy to remember trick. Ni more debt is better. NOI structure doesn't matter. In theory, debt helps, with tax. Traditional use debt carefully, balanced. Conclusion. Capital structure theories help managers decide how much to borrow and how much equity to use. Right decisions improve company value, reduce risk, and attract investors. Next important long question is 3. Concept and financial effects of leverage problem. Subhash Traders Limited achieves BP on selling 300 units, selling each unit at 18 rupees. The variable cost is 12 rupees. The company has to make 12,000 rupees payment towards interest on loan. The company sold 4,000 units. Calculate degree of operating leverage, degree of financial leverage and degree of total leverage. Subhash Traders Limited leverage calculation, explained step by step. What are leverages? Operating leverage, DOL, impact of fixed business costs on profits. Financial leverage, DFL, impact of interest, loan costs on profits. Combined leverage, DCL, total effect of both. Given. Selling price per unit is equal to 18 rupees. Variable cost per unit is equal to 12 rupees. Break-even units is equal to 300 units. Units sold is equal to 4,000 units. Interest, loan, is equal to 12,000 rupees. We need to find degree of operating leverage, DOL. Degree of financial leverage, DFL. Degree of total, combined, leverage, DCL. Step-by-step solution. Step 1. Calculate fixed cost using break-even point. At break-even point, contribution is equal to fixed cost. Contribution per unit is equal to selling price, variable cost, is equal to 18 rupees to 12 rupees is equal to 6 rupees per unit. At BEP, 300 units. Fixed cost is equal to 300 units times 6 rupees is equal to 1,800 rupees. Step 2. Calculate sales and contribution. Total sales is equal to 4,000 times 18 rupees is equal to 72,000 rupees. Total variable cost is equal to 4,000 times 12 rupees is equal to 48,000 rupees. Contribution is equal to sales, variable cost is equal to 72,000 rupees to 48,000 rupees is equal to 24,000 rupees. Step 3. Calculate EBIT, earnings before interest and tax. EBIT is equal to contribution, fixed cost, is equal to 24,000 rupees to 1,800 rupees is equal to 22,200 rupees. Step 4. Calculate EBIT, earnings before tax. EBIT is equal to EBIT, interest, is equal to 22,200 rupees to 12,000 rupees is equal to 10,200 rupees. Now calculate leverages. Operating leverage, DOL, is equal to contribution EBIT, is equal to 24,000 rupees, 22,200 rupees, 1.08. Financial leverage, DFL, is equal to EBIT EBIT, is equal to 22,200 rupees, 10,200 rupees, 2.18. Total leverage, DCL, is equal to DOL times DFL, is equal to 1.08 times 2.18, 2.35. Final answer, easy to remember. DOL 1.08 business profit is slightly sensitive to sales. DFL 2.18 financial risk is moderate due to interest. DCL 2.35 overall profit will change 2.35 times for every 1% sales change. Tip to remember. DOL times DFL is equal to DCL. Operating impact times financial impact is equal to total impact. Next important long question is 4. The capital structure decision in practice. What is capital structure? Capital structure means how a company raises money to run its business. It is the mix of debt, like loans, and equity, like shares, used to finance its assets. Why is capital structure important? Choosing the right capital structure helps a company reduce cost of capital, loan interest versus shareholder expectations, maximize profits and returns to shareholders, reduce financial risk, maintain control of the company. Capital structure in real-life practice. In theory, companies should try to find an optimal capital structure. But in real life, companies look at many practical factors. 1. Cost of finance. Companies compare the cost of debt, usually lower but risky, and equity, costlier but safer. Example, A company may take a bank loan at 10% interest instead of issuing shares that expect a 15% return. 2. Control. Issuing more equity shares means giving up ownership. So promoters may prefer debt to retain control. 3. Risk level. Too much debt increases risk, need to pay interest even in losses. Small startups avoid debt, while large firms use a mix of debt and equity. 4. Market conditions. When interest rates are low, firms prefer loans. When stock markets are booming, they may issue shares. 5. Flexibility. Debt gives flexibility, companies can repay and reduce burden. But equity is permanent and can't be taken back easily. 6. Profitability. If profits are high, companies can afford more debt. Low profits mean relying more on equity. Example, simple and practical. Let's say ABC PVT Limited needs 1 crore rupees. It can raise 60 lakhs rupees via bank loan, debt. 40 lakhs rupees by issuing equity shares. This mix gives them low overall cost as debt is cheaper. Retained control. Less equity means fewer shareholders. Tax benefits. Interest on debt is tax deductible. So, ABC chooses this structure after analyzing all factors. This is the capital structure decision in practice. Easy tip to remember. Capital structure is equal to right balance of debt and equity based on cost, risk, control, and market situation. Next important long question is 5. Measurement of cost of capital, component costs. What is cost of capital? Cost of capital means the minimum return a company must earn from its investment projects so that it can pay its investors, like shareholders, lenders, etc. Every company collects money from different sources like equity, shares, debt, loans, preference shares. Each of these has a cost, which we call component cost. What are component costs? These are the individual costs of each type of capital. Let's understand one by one. 1. Cost of equity, K. The return expected by shareholders. Formula approx. K is equal to D1P0 plus G, where D1 is equal to expected dividend next year. P0 is equal to current share price. G is equal to growth rate of dividend. Example. If a company gives 5 rupee dividend, share price is 100 rupees and dividend grows 5% yearly. K is equal to 5 100 plus 0.05 is equal to 10%. 2. Cost of debt, KD. The interest the company pays on loans, adjusted for tax. Formula. KD is equal to interest times 1 tax rate. Example. Loan interest is equal to 10%, tax rate is equal to 30%. KD is equal to 10% times 10.30 is equal to 7%. 3. Cost of preference share capital, KP. Fixed return paid to preference shareholders. Formula. KP is equal to preference dividend net proceeds. Example. Dividend is equal to 8 rupees, share price is equal to 100 rupees. KP is equal to 8 100 is equal to 8%. 4. Retained earnings, KR. Even if profits are not given as dividends, investors expect returns. So, cost is same as equity. KR is equal to K. Why component cost is important? Because it helps in calculating weighted average cost of capital, WACC, the overall cost of capital, which is used in investment decisions. Easy tip to remember. K, KD, KP, KR is equal to cost of equity, debt, preference, retained earnings. Learn their formulas and logic, and you'll master this concept easily. Next important long question is 6. Weighted average cost of capital, WACC, problem solved. What is WACC? WACC means weighted average cost of capital. It tells us the average cost of funds, like equity, debt, etc., used by a company. It is used in investment decisions, like whether to accept or reject a project. Given problem. A company has the following capital structure. Source amount, cost, %. Equity capital 5 lakhs 12%. Debt 3 lakhs 8%. Preference share 2 lakhs 10%. Calculate WACC, no tax. Step-by-step solution. Step 1. Find total capital. Total capital is equal to 5 lakhs rupees plus 3 lakhs rupees plus 2 lakhs rupees is equal to 10 lakhs rupees. Step 2. Find weights of each source. Weight of equity is equal to 5 lakhs 10 lakhs is equal to 0.50. Weight of debt is equal to 3 lakhs 10 lakhs is equal to 0.30. Weight of preference is equal to 2 lakhs 10 is equal to 0.20. Step 3. Multiply each cost with its weight. Equity 12% times 0.50 is equal to 6.00%. Debt 8% times 0.30 is equal to 2.40%. Preference 10% times 0.20 is equal to 2.00%. Step 4. Add all to get WACC. WACC is equal to 6.00% plus 2.40% plus 2.00% is equal to 10.40%. Final answer. WACC is equal to 10.40%. Easy tip to remember. WACC is equal to cost of each source times its weight. Add all is equal to your WACC. Use of WACC. If a project gives return more than WACC, accept it. If return is less than WACC, reject it. This is how companies grow wisely using smart finance decisions.